Thank you for standing by, and welcome to the Breville Group Limited FY26 first half results investor and analyst briefing. All participants are in a listen-only mode. If you wish to ask a question, you will need to press the star key followed by the number 1 on your telephone keypad. I would now like to hand the conference over to Martin Nicholas, Group CFO. Please go ahead.
Thank you, and good morning to everyone. I'm Martin Nicholas, Breville's Group CFO, and it's my pleasure to welcome you to the presentation of our first half 2026 results. I'll be walking you through the group's financial results, and then Jim Clayton, our CEO, will provide an operational and strategic update. But I'd like to start our presentation today by acknowledging and paying our respects to the traditional custodians on whose land we meet today. I would like to pay respect to their elders past and present, and further extend that respect to all Aboriginal and Torres Strait Islanders present today. We celebrate the continuing contributions of their food culture and their connection to and custodianship of this country. Turning to the presentation, we'll start on slide 4 with an overview of our first half results. A challenging but encouraging half that demonstrated both BRG's tactical agility and consistent growth track record. We delivered double-digit revenue growth, continued to invest in the future of the business, and successfully managed the significant impact of US tariffs while maintaining profitability and improving our net debt position. Let's walk through each of those highlights. In first half 26, we delivered double-digit revenue growth of 10.1% against a backdrop of resilient premium consumer demand, supported by continued NPD and the coffee tailwind. Record sales of $1.1 billion for the half represent a doubling of revenue over the last 6 years. Our group gross margin was impacted by the significant impost of increased US tariffs on China and on the rest of the world. We successfully mitigated much of this impact and future-proofed the business with the diversification of our 120-volt production to new, lower tariff locations. Jim will say more about this later in the presentation, but the relocation project has been highly successful, and we met our target of having 80% of gross margin, US gross margin, manufactured outside of China by December 2025. A remarkable operational achievement. We held our prices on our US core range and took selective price increases on our tail range, and we worked our distribution mix. This clawed back some of the remaining on costs, with some also offset by gross profit increases in other theatres. Net, our gross margin decline was successfully contained to 130 basis points, and we grew gross profitability by 6.3%. During the half, we kept our focus on driving future growth, with investments in our new markets, China, Middle East and Korea, and an increased investment in marketing and in D&A itself, partly driven by manufacturing diversification. The resulting flattish EBIT of $145.8 million was in line with our plan. Our underlying cash flow was strong and net debt improved over the prior comparative period. Overall, an encouraging half, and I'm pleased to note that a fully franked interim dividend of 19 cents, an increase of 5.6% on the prior period, we paid in March. So let's go into a bit more detail. Turning to slide 5, we see key segmental results. The global product segment grew revenue by 10.9%, or 9.3% in constant currency. Our MPD landed well, with the Oracle Dual Boiler and the Encore ESP Pro generating strong consumer responses and helping to drive healthy double-digit coffee growth. Our cooking and food preparation categories both recorded high single-digit revenue growth. Our direct countries, where we have boots on the ground, grew in double digits in constant currency, with our newest geographies, Korea, China, Mexico and the Middle East, growing at over 50%. We saw slower growth in distributor-led geographies, which cycled a strong first half 25. While tariff uncertainty remains, With the Supreme Court ruling still awaited, the USMCA renewal in July, and feasibly new tariffs, we are ready to tactically respond to these new challenges if and when they occur. Our distribution segment fulfilled its tactical role, delivering an increase in gross profit of $2.1 million. Turning to slide 6, we show our geographical theatre performances. And our first half 26 pleasingly saw underlying strength in all theatres. The Americas grew total revenue by 11.1% in constant currency, with coffee in double-digit growth led by premium MPD launches and a really strong performance from the Barista Express. Food preparation also grew double-digit, with cooking in high single-digit. Exciting also to note that 300 extra store-in-stores were installed in Best Buy in the USA in November. And turning to APAC, our direct markets, that's Australia, New Zealand, Korea, and now China, delivered double-digit constant currency revenue growth. MPD landed well, and although still small, China sales were encouraging, with Korea continuing to go from strength to strength. Total theatre growth was 6.1%, with cyclically weaker sales growth in distributor-led markets after a strong first half 25. In EMEA, our direct markets, the UK, the EU, and the Middle East, again grew in double digits, led by coffee and MPD. Growth was strongest in the EU and the Middle East, with the UK in solid single-digit growth against a challenging economic backdrop. Overall, theatre growth of 7.6% includes more moderate performances in distributor markets, including Turkey, the Nordics, and Southern Africa, after a strong first half 25. Turning to slide 7, here we see our EBIT growth drivers across the first half. Volume growth was healthy, but US tariffs increased COGS, leading to gross profit growth of 6.3%. In terms of operating expenses, we maintained our discipline in investing in future growth drivers, investing $12.9 million, or approximately 60% of the OPEX increase, in growing new markets, in marketing, and in D&A itself driven by new production facilities and MPD. Outside of Forex translation, the increase in our other OPEX was modest. EBIT growth of $1 million, or 0.7%, was in line with our plan and reflects the gross tariff exposure we absorbed during the half, our tactical approach to managing through this turbulent period, whilst keeping an eye on sustaining and investing in future growth. Turning to slide 8, we look at the balance sheets. Here we saw a healthy half of underlying cash generation, delivering an improved net debt position, despite funding an increase of $42 million in US tariff cash payments in the half. Reported inventory was flat year on year, with lower unit holding in the US effectively offsetting a cost per unit tariff-led increase. Inventory was broadly flat in our other theatres. Looking ahead, our transition to our new manufacturing facilities will necessitate an earlier build of 120-volt inventory for the FY27 peak season. We will start building for peak in March rather than July, with our resulting reported June inventory balances planned to be higher than in previous years. Turning to receivables, these seasonally peaked in December at $515.7 million, or 7.6% above prior year, with debtor days in line with the prior period. In January, as peak receivables were collected, the group moved back into a net cash position of $70.1 million as at the 31st of January 2026, which compares to $18.7 million in the prior period. PPE and development costs together reflect the continued investment in our growth drivers, our tooling investment in alternative manufacturing sites, our store-in-store CapEx investments, and our investment in new products and solutions. As more new products are developed and then launched, capitalized development costs will grow, in turn fueling future growth. The intangible balance shown here is a good leading indicator of expected future growth, with the growing balance signaling that we have a number of projects moving towards launch or recently launched. As mentioned earlier, with strong underlying cash flow, our December 31st net debt position improved by over $11.5 million over the PCP to $43.6 million. Our balance sheet remains in good health. At 0.2 times the last 12 months EBITDA, BRG remains conservatively geared, and we have significant cash and unused debt facilities, providing flexibility for further expansion. Before concluding my review and handing over to Jim, there are 4 key takeaways from our first half performance that I'd like to emphasize. Firstly, our revenue growth drivers remain robust, with MPD, new geographies, our direct markets, and the coffee tailwind delivering another record half. Our net sales have doubled over the last 6 years. Secondly, the impact of US tariffs have been well managed within a flattish EBIT, and the timely manufacturing diversification of our 120 volts variants was a remarkable logistical achievement. Thirdly, we continue to manage the business for the long term. While short-term margin pressure was real, we have increased our strategic investment in our growth drivers. Lastly, this is all underpinned by a strong underlying cash flow, low leverage, and a healthy balance sheet, providing funding flexibility for further expansion. So overall, a very solid set of results. And with that, I will hand over to Jim.
Thanks, Martin, and good morning to everyone. Now that Martin has walked you through our first half 26 results, I'm going to pivot to our manufacturing diversification program, some updated numbers from our bean service, show you our new products and highlight a few marketing investments, and lay out our new transformation program, then end with my thoughts on the second half and outlook for the year. At slide 11, as a reminder, our manufacturing diversification program began in FY23 with the production of the Barista Express in Mexico. We accelerated the program in FY25 and set the objective of sourcing at least 80% of U.S. gross profit dollars from locations outside of China by the end of the first half of 26. I'm pleased to report that we achieved this goal. I cannot overstate the complexity of this task given the speed. Working closely with our manufacturing partners, we moved what we planned slightly ahead of schedule, and equally importantly, are delivering the same quality of products off the new lines. In the second half, the program enters its next phase, continuing to move remaining SKUs while transitioning already moved SKUs into a component localization exercise to optimize the long-term production costs. The approach we've taken with our supply chain was designed to minimize risk and disruption while still achieving our objective. Our NPD team still works directly with our manufacturing partners in China on new products, and all 240 volt products continue to be produced in China. It's just the vast majority of our 120 volt variants for the U.S. market that have moved to other locations. The heavy lifting is complete. The team is now working through the program tail at a controlled pace. Slide 12. Now onto the snapshot of the bean service. The growth rates you see here represent calendar year 25 over 24. The service continues growing at an accelerated pace, a testament to consumer demand and service quality. When services grow this quickly, they typically experience infrastructure problems. Our team has stayed ahead of the curve. We just handled the volume spike of Black Friday through Christmas, and our platform and roaster partners didn't miss a beat. The architecture and processes are battle tested and sound. Now on to new products. In FY26, we've been rolling out the Oracle Dual Boiler, which recently won the Best New Product at the World of Coffee in Dubai, the IQ Toaster, and the Encore ESP Pro from Baratza. All 3 products are performing quite well in market, and we're getting positive consumer reviews. In late December, Williams-Sonoma launched the new mixed metals range. The brass range we launched with them last year performed quite well, and they're equally excited about this range. Many kitchens in the U.S. have a mixed metals design, so these products will slipstream quite nicely into that look and feel. On to slide 17. I've told you I will only disclose launched products, but I'm making an exception here because this demonstrates something important about our portfolio strategy. This is the Mara X3 by Lelit, launching next month in Europe and the UK. Lelit has established itself in the prosumer category with Bianca, also in the picture, bringing flow profiling, popularized by Slayer in the commercial space, to the prosumer. Mara X3 now brings this capability to the heat exchanger platform through the Pagaia, which is Italian for pedal, the small finger-driven knob that gives users total control of pressure throughout the shot. Pressure profiling lets you get the best result possible in the cup for any given coffee. What makes this particularly noteworthy is that Pagaia is leveraging a BRG patent. It's a concrete example of Lelit joining BRG and then unlocking value for its customers using BRG IP. Mara X3 combines this new capability with a refined design language as well as Lelit's patented temperature control capability. Slide 18. I've highlighted a few of our go-to-market investments that we implemented in the first half of 26. If you recall, we opened a cafe on the first floor of our headquarters in Seoul. What you see in the upper left is the next iteration of this format, a standalone cafe in Seongsu, a hip shopping area in Seoul. This is a cafe-first Breville store second format, and it is performing quite well. In the upper right, you see our store-in-store in El Palacio de Guerrero in Mexico City. El Palacio is the most premium department store in Mexico. We delayed going in until they agreed to let us execute store-in-store formats. So this store actually represents our entry into the retailer. And at the bottom, you see an image of a large project we executed in October, November, which was rolling out 300 store-in-stores in Best Buy. Best Buy consolidated their entire in-store SDA offer to 3 primary brands and 2 secondary brands. The primary brands, which are Breville, Dyson, and Shark Ninja, will execute store-in-store formats that we move first. DeLonghi and Bella, which is a mass market brand, are the secondary brands which share an aisle. All other brands were deranged. This is a material change to the retail channel structure in the United States. Slide 19. I'd now like to spend a bit of time talking about the next phase of BRG's transformation. Slide 20. To be fair to the team, they've been on quite a journey. On my first day, I promised change and said it would never stop, and I'm doing my best to keep that promise. As a quick recap, Phase 1 was about a total replatforming of the company, organizational structure, key processes, and the technology platform. With that in place, we kicked Phase 2, which was about globalization. With the basics of a hardware company in place, we started Phase 3, which was the art to solutions like Breville Plus and Beans. Each phase built on the last, replatforming, globalization, solutions. Phase 4 is different. AI doesn't sit on top of what we built. It cuts across every function, every geography, every process. It's holistic. And because of the foundation we've laid, we are executing at pace. Slide 21. In August of 2025, Cisco surveyed over 8,000 companies globally to assess AI readiness across 6 dimensions: strategy, infrastructure, data, governance, talent, and culture. Only 13% qualify as what they call pace setters, companies positioned to execute. Pace setters, they claim, are 1.5 times more likely to achieve measurable gains in profitability, productivity, and innovation. We didn't participate in the survey, but when you map BRG against the criteria, a single global instance, centralized data lake with AI-configured data streams, AI-capable engineering teams, formal governance structure, we're squarely in the top 13%. This isn't aspirational, it's a description of what we've already built. I know I've bored many of you over the years with commentary on our corporate platform. Here's proof that it matters. Those investments position us to rapidly fold AI into our architecture. Slide 22. Our program has 3 components. First, training and enablement. This is a top-down effort. As a result of our initial training program, we now have over 1,000 employees actively using AI every month. We are now in the throes of Phase 2 training, which teaches employees how to amplify their individual capabilities by leveling up their AI skills. I am personally leading this phase, training every geography and function across multiple LLMs. I accept this is unusual, not many CEOs are personally doing this. It's both an indication of how important I believe this transformation is, and it signals that becoming an AI-driven organization is non-negotiable. Second, agents and process automation. This is a process-driven component led by our CTO and his team. We partnered with functions to implement agents in high-impact areas, specifically targeting high-volume, high-friction, low-risk processes first. Pacing here is thoughtful and deliberate with significant test and learn. Third, AI infrastructure. This is led by our data science team and is aimed at AI enabling our entire platform, plus implementing governance and security, which our CIO leads. We are well down this path, though this is an adaptive project that will morph as the technology evolves. While we have many agents in production, I want to give you one example to show you what this looks like. In October, we took BRG AI live for our customer services teams globally. This is an AI support service that touches every facet of customer support: training, documentation, case resolution, and knowledge management. These are the early results from our global team. Onboarding time is down 40%. Employee turnover has dropped significantly. Support documentation is both faster to create and of higher quality. Cases are resolved in fewer interactions, cutting time to resolution, which in turn reduces product replacements. Two things worth noting here. First, these results are coming from phase one of the project. We haven't even optimized it nor added incremental capabilities. Second, we built it ourselves. A single engineer built BRG AI in 3 weeks, followed by 1 month of user acceptance testing before going live. This signals the state of our underlying platform as well as the talent within our team. Most companies would have to outsource this to a vendor. We have the internal capability to build our own AI solutions, which I believe will manifest itself as a fundamental advantage going forward. This AI program is truly transformational because AI isn't just a new tool in the toolbox. It is a re-architecting of the entire enterprise. You eat the elephant one bite at a time. While there are many benefits, I'm most excited about 2 in particular: quality and speed. Taking a 6-month process and turning it into a higher quality 3-month process. Increase decision-making velocity and you increase enterprise velocity, making us more adaptive to both opportunities and challenges. Slide 24. As I think about the second half, it's certainly a continuation of projects in flight: the AI transformation program and the manufacturing diversification program. I'm not coming from the latter, as we will see a change in how we build inventory for peak season. We will peak earlier and the curve will be flatter. As Martin mentioned, we will buy the same amount of inventory, but we will build the 120 volt variant earlier, which will naturally affect the June reported inventory and cash levels. Slide 25. Given the magnitude of the U.S. tariffs that our value chain is absorbing in FY26, we expect EBIT for the year to be a slight uptick over last year. Absent material changes to the U.S. tariff program, this is a one-time event with FY27 running against an FY26 baseline. With that, I'll now hand the call back to the operator for any questions you might have on our first 26 results.
Thank you. If you wish to ask a question, please press star 1 on your telephone and wait for your name to be announced. If you wish to cancel your request, please press star then 2. If you're on a speakerphone, please pick up the handset to ask your question. We kindly request that each participant limit their questions to 1 per turn. Please refrain from asking multi-part questions in order to ensure everyone has an opportunity to participate. If you have additional questions, please rejoin the question queue. The first question today comes from Sean Cousins from UBS. Please go ahead.
Good morning. Just a question regarding the tariff impact. You noted that was well managed. Beyond the tail pricing, was the real skill and the real way it was well managed just that retailers, the distribution mix and the product mix, noting you launched some new products. Just curious around how you've managed the tariffs and how that's gone relative to your expectations, please. And if that's the plan for the second half of 26 as well, please.
No problem, Sean. The biggest action that we took, or the biggest mitigant that was played, was the moving of the 120-volt manufacturing out of China into lower tariff locations. That's probably the biggest mitigant that was played. And then we talked, you mentioned also about distribution mix and around pricing on the tail. Yeah, but we tried to lay each of those out in the presentation. The biggest thing was getting out of higher tariff location into lower tariff location. That's gone extremely well, extremely well. And then we've honed our channel distribution and taken some price rises. And I also called out a little bit that we had slightly improved gross margins outside of the USA, which in the total group result also gave us some mixed benefit.
Fantastic. Thank you.
No problem.
Thank you. The next question comes from Tom Kirath from Barrenjoey. Please go ahead.
Morning, guys. Yeah, just following on from Sean's question on the tariffs, is it fair to say that first half 26, that's like the peak impact from tariffs because you were selling a bunch of product that was made in China, and then as we kind of get into maybe FY 27, you should actually see some relief on that front and maybe some gross margin expansion?
I think that's right, all else being equal. And that's a big statement, Tom. I don't think we've had a period so far where we've had stability in tariffs. But if everything freezes exactly like it is now, yes, you're right. We will increase the mix of products that's bought into inventory then sold that came out of those new plants, and we will have decreased the amount that came out of China. So yeah, there would be a positive mix impact going forward, all else being equal. And then we've got foreign exchange, we've got pricing, we've got shipping costs, we've got all that noise, normal noise going on. But just related to the tariff part, you're right, we'll have a better mix going forward in second half 26 and definitely into first half 27.
Great. That's really clear. Thanks, Martin.
Thank you. The next question comes from James Lee from Goldman Sachs. Please go ahead.
Hey, team. Thanks for taking my question. My question's around the indirect markets, noting that there's some cyclical weakness that you've called out there. How have conversations with distributors gone in those markets, and how should we think about this going into the second half?
So what's basically happening is distributors roll on a bigger wave, in a sense, than what happens inside of a half because their lead times are a lot longer. So if you look at them, and if I'm pulling CAGRs, I'll pull them over a 2-year period in a sense because they ebb and flow because of the longer lead times. And this is that natural, we had let's call it the up wave in the first half of 25. You've got that as a denominator, which then drives the down wave. And it's because we're reporting revenue on what we sell them, not what they sell out. And so this is how they manage their inventory as it flows through.
Correct. And we called out, James, this time last year, we called out really strong performance from distributors. Go back 2 years, we called out weaker performance from distributors. So it's definitely a cycle or a wave that's flowing through. And the scale of that volume, it's about $40 million in EMEA, maybe $20 million in APAC. So it's not the largest part, but it's enough at the edges to either enhance the growth number for the theatre or slightly dampen the growth number for the theatre. And that's why we've got in a habit of calling out how distributors have gone half after half after half.
Awesome. Thanks, guys.
Thank you. The next question comes from Craig Woolford from MST Marquee. Please go ahead.
Good morning, Jim and Martin. My question is a different one, just on the property, plant and equipment growth. It was quite high, but then the depreciation amortization increase was meaningful, but not quite matching that. Should we expect a significant step up in depreciation and amortization in the second half as the sort of tooling depreciation kicks in?
Yes, but it's not really the tooling. That's more the storing stores going into Best Buy that you've seen boosting the actual CapEx spend or the fixed assets in the first half. And yes, they will start amortizing. They went live in December, so they're now amortizing in the second half.
Should it match PP&E growth? Like as in just quite
yes, should match, if not slightly exceed it as you catch up. So yes, we've modelled and we expect to step up in DNA in the second half. If you just look at it half on half on half, that's been happening over the last 4 or 5 years even. So each half we invest more, and then depreciation amortization catches up with a lag. Last half year it was tooling in the factories. This half it's SIS in Best Buy, and each one is lagged slightly. So yes, I would expect it to catch up, Craig.
Right. Thanks, Martin.
Thank you. The next question comes from Sam Haddad from Petra Capital. Please go ahead.
Hi, Jim. Hi, Martin. Just a question around pricing. Just to clarify, so you remain steadfast on your core products and only raise prices on your non-core, and how are you seeing competitors respond so far, and any further clarity on price elasticity with US consumers? Thank you.
So we're one, just to be clear, we're only focused on the United States. What I would say on the, I'll pick on espresso first or coffee first, which is basically everybody held steady. So in coffee, in coffee there wasn't really any movement at all. On the other core category in the US would be ovens, and you saw some of both, right? Which is you saw some hold and some move. And that's been stable since it happened. You know, it's kind of like everybody made the first move, which was either no decision or a decision, and there hasn't been a lot of movement since then.
Thank you.
Thank you. The next question comes from Olivia Cullen from E&P Financial. Please go ahead.
Yeah, hi guys. It's in a localization cost opportunity. Can you maybe try to quantify for us what the size of that could be, you know, when you get to where you want to be? So I suppose maybe a good way to look at it is, you know, what are the first half FOB prices, you know, for the 120 volt range out of the new territories versus what, you know, you were buying them out of China, and what's the target, you know, relative to China?
Yeah, I'll try and answer that, Olivia, but there's a lot of movement in mix going on through that first half. I think that was the point of an earlier question. So in the first half, our FOBs were partly out of China at China tariffs, and then progressing to add, as an example, espresso machines out of Indonesia with Indonesian lower tariff. The second wave now is what you're referring to is to localize some of the componentry out of Indonesia rather than bringing the componentry from its original locations. That wave is underway now, but as it bites, I think that's more going to impact FY27 onwards, because we're already building the inventory for peak season 27 now. So we're already, it's not going to impact second half 26. It's too much of a lag. As we now look to localize, broadly speaking, we'd hope that the FOBs out of Indonesia, Cambodia, and Mexico would be similar to the original FOBs out of China, but you've got to strip the tariffs out of all of them to see whether you're in an advantage or disadvantaged position. Overall, the world has got more tariffs than it was a year and a half ago. Yeah? So overall, even out of the new locations, you're paying the tariff. Are we doing localization initiatives? Of course. And we always look to reduce our FOBs where we can, of course. But it will take some time for that to flow through. I think there's other factors flowing through the margin, which is the mix, which I'm more monitoring over the next 6 months, say.
I think the other thing I'd add on localization is this will have a longer tail, which is there's kind of 2 ways you solve this problem. One is to find a local supplier of that particular component, or teach them how to do it and qualify them and so forth. And then the other thing that's happening is a lot of the, let's call it, core manufacturers to the entire vertical themselves are setting up manufacturing locations in Southeast Asia and Mexico. It takes them time because they have to set that up, and once they do, then effectively, you know, everyone in that geography benefits from that. So all of these are lots of moving pieces because now we're at the BOM level. And so you'll just be chipping away at it over time.
But it Is the next wave of focus on localization? Yes, it is. And we just see that flow through over the coming months and years.
But I suppose, maybe if I'm allowed one quick thought, I suppose if mix is a positive in FY27 versus FY26, as in mix of locations, Indonesia versus China, etc., localization should also be a positive in FY27 and beyond versus FY26. Is that kind of how we can think about it?
Agreed. With all else being equal, both of them are tailwinds, yes.
Perfect. Thanks.
Thank you. The next question comes from Paul Segal from Jarden. Please go ahead.
Hey, good morning, Jim and Martin. Just on the EMEA business, can you unpack the slight softness you called out in the UK? You're talking about the challenging macro, but can you talk about any kind of category-specific trends that may have driven the softness, and how do you think Breville performed versus peers in the UK?
There wasn't anything. To be fair, I didn't look at it at that level of granularity.
Yeah.
Just honestly, because I don't. So I don't think there was any one thing or another, so to speak, right? It was just thing. Flip side is it's still growing, right? It just wasn't, whatever it was.
Almost the point we're making, Paul, was it was still growing high single digits against a pretty miserable high street environment. Times are pretty tough in the UK, and we were quite pleased to have a single digit growth in the UK. It was lower than the rest of the EU and Middle East, but it was still positive.
If it was -15, I would have looked at a high single digit, where the roll up of Europe as a whole is double digit. I move on to the next issue.
Cool. Thanks, guys.
Thank you. Once again, to ask a question, please press star one on your phone. We ask that questions be limited to one per person. The next question comes from Tim Lawson from Macquarie. Please go ahead.
Hey guys, thanks for taking my question. Can I just dig into the weakness in the third-party distributors for a minute? Did you say that in Australia, in APAC, that about 20 million is from third-party distribution in the revenue line?
About that, that's right. Yes.
Because if I put that into a sort of simple table, assume I've got this right, and you've got double digit in your direct distribution, that suggests that third-party distributor was materially negative. Is that correct?
Yeah, I think this is, so you just need to be careful, which is, that would mean, last, whatever. First half of 25 is materially positive. When APAC
we printed plus 16% in first half 25.
Yeah, it's a wave. It's not a weakness. It's a timing. So there's a big difference between these two things. So you just got to be. This is the reality of distribution, and I think what EMEA is more exposed.
Yes.
Like in the Americas, we don't really have a ton, right? So you don't have this, kind of third wheel rolling around. But EMEA has the most exposure, in a sense, to the size of revenue that comes from distributors, and then APAC's got a smaller number, and they will all roll on a wave. It's never a straight line.
Okay, I'm just trying to understand, is there some problem with that? I appreciate you trying to point a 24-month sort of story,
but
do they have like a working capital to deal with the sort of demands that you're putting on them? Do you need to move to a direct distribution model in those markets?
No. There's nothing wrong with them. Like, I may move for a different reason. There's nothing wrong with them. This is just a cycle. If there's something wrong with a geography, we'll switch. Or if we think there's a better opportunity. So as an example, one of the things that rolled through EMEA is we switched distributors in South Africa. And when you do that, you got the drawdown and then the cut over and all this kind of bit, right? So that was basically the EMEA story, was we decided to move from one distributor to another. And that's kind of a one-time event. And then you've got other distributors that are just cycling the construct of when they place the order versus, when we report the half. So you just can't, I don't know how to describe this other than you cannot tell how distributors are performing by looking at any half. You have to pull it out over like an 18-month period to get a sense of is there something wrong with this distributor.
They buy inventory, they work through inventory. They buy inventory, they work through inventory. And depending on where they are on that cycle, Tim, you've either got a strong positive or you can have a negative during that period. And that's why we call it out mainly at the halves. We seldom talk about the full year because it's once it's diluted over a full year, it hardly dents the number.
So can you see the inventory that sits at the third-party distributors, and is it materially lower than what it was this time last year?
No, I can't see it. Meaning, I can't log into their systems. We thought I'm not even sure what they bought. And then when they're placing, they have to place orders really far out, so to speak. So within that construct, you have a whole lot of visibility to what's coming because they have to deal with a very long lead time. I mean, if I go back to 15 and 16, there used to be this kind of whole, when we weren't direct kind of anywhere other than Commonwealth, that was a big piece and it all moved this way. And they had bringing 9 to 12 month lead times. And so they have to kind of they put all their orders in to get everything that they need for a period. So as an example, they have to order, they've got to order like early in the second half so that they can have a high season. And while we were going peak inventory, like we were starting for high season in July, they got to get in front of that because we're about to blow through all the capacity as our direct markets climb. So they got to go all the way in the back, and order really early. And then, so all of a sudden you'll go, oh my goodness, that was a big order. And then they'll go apply it for 6 months because they did that. And then it's just weighty is all it is.
I think the key message, Tim, is that in markets where we're direct, we grew double digits America, double digits EMEA, double digits APAC. And then there's this volatile, smaller piece which can impact the reported number, and that's why we shared it with you. But the key message is how we're performing in those direct markets that we focus upon.
Okay, that's great. Thanks for the clarity.
Thank you. The next question comes from Sean Zhu from CLSA. Please go ahead.
Oh, hi, Jim and Martin. Thank you for taking my question. You talked about the extra product display in Best Buy in the US. Did you see much benefit in the first half from this arrangement? And what's the early signs there? Thank you.
Yeah, so there's a meaningful impact, right, with Best Buy. So you've got the question of did Best Buy steal market share from someone else? In that instance, we don't see it in the total, right? But what this decision at Best Buy is going to materially affect the players that were chosen and more materially affect the ones who weren't because it's like 1,000 doors. And by the way, this is not, just happening in small domestic appliances. It's TVs, it's every category. They very much rationalized and picked their winners and got rid of everything else. So what you end up with is this construct of there's a range out that happens, which is across all 1,000 doors. They've made this decision. Now, in the tail, they won't carry as many of the SKUs, but they're only going to carry SKUs from the 5 that they chose because that's all they buy from now. So you'll get this load in, so to speak, happen across the system, and then you're going to see an accelerated sellout from Best Buy by definition because all of a sudden they deranged at the same time they expanded range, kind of in your SKUs. And if you're going to Best Buy, you're either buying Dyson, Sharkdinja, or Breville, or you're going to the second tier and getting something from the Longear Bella, and that's all you can buy. So in a sense, all of those brands will feel a tailwind to the extent that they have SKUs on the shelf. So of all the players, we have the biggest range in the sense of number of SKUs, and it's pretty static. I mean, honestly, it's something, if you go to the States, you kind of have to see it to believe it. I used to work at LG, so I wanted to go to the TV and see what they did, and it's a big call.
Thank you. And you guys have a very similar, not exactly the same, but very similar arrangement in Target. That's my understanding. Is that right? And what's the context there, please?
So Target, we went into Target maybe
3 years ago.
3 years ago.
Yeah.
And you can ask them how they want to describe it. I would say we're kind of the lead horse in Target. It's performing exceptionally well. And we didn't really talk about this, but there was a big store-in-store play on the Best Buy side, which is what this PP&E is going to roll through. There was also a big investment on the Target side of stepping up that offense, but it's not that there's sleds or whatever. It's a different kind of format that we just ran through ran through OpEx, because it's not something that will definitely last for a longer period of time. But Target has got us leaning into them as well. So both of those retailers are getting a big, let's call it a Breville tailwind in the sense that they pulled us through.
Yeah.
Cool. Thank you. I'll jump back to the queue. Thank you.
I think the only thing I would add is Target didn't go through the deranging side of the equation, which is they're picking who they're going to lean into and let, kind of invest in the aisle, so to speak, kind of category captain-like, but they'll still have all the other brands. The big change in Best Buy was not just that first part, but it was the deranging of KitchenAid, Keurig, Vitamix, Nespresso, like you go down, it's everyone. And that's the part that's pretty fascinating.
Thank you. The next question comes from Sam Teeger from Citi. Please go ahead.
Hi, Jim. Hi, Martin. Just wondering, given the success you're having in new markets such as Mexico, Korea, China, and the Middle East, what's the likelihood of additional new markets in the second half for FY27, and what geographies would have the most appeal?
So there won't, I don't mind saying this because we're so busy, there's not going to be a new market in 27. The geographic expansion lever is, quote, always on. I think the U.S. put a lag in that construct, which is we had to pull, a material portion of the team out to move the entire 120-volt stuff into all these different locations. So in a sense, that was the geographic expansion that's happening, so to speak. And then you'll also see it across, within this construct, I'm talking about the Breville Sage brand. You'll see continued movement of the other brands as they slipstream behind it. But what I can say is we're not done. We're just busy.
All right. Thank you.
Thank you. That does conclude today's question and answer session. The conference is now concluded. Thank you for participating. You may now disconnect.